Auna's Q2 2026 top line beat consensus, but the bottom line just fell right through the floor with a massive 42% EPS miss.
Yeah, so revenue came in at 12,238 million Peruvian soles. That's, up 9% on an FX neutral basis. And they reaffirmed their full year guidance for 12% revenue growth. But they did flag that adjusted EBITDA is now expected at the absolute low end of their 10% to 14% range.
Which completely explains the whiplash on the chart today. I mean, Auna plunged 13.6% pre-market down to $4.68, but then completely reversed course during the regular session.
Yeah.
Actually ground back to close slightly green at $5.43.
Right. It was wild to watch.
Exactly. So if you're watching this stock, our mission today is to figure out why institutional buyers scooped up shares when operating costs are, clearly chewing up profits. It's honestly like a restaurant with a line out the door, but they're losing money on every single plate they serve.
That's a really great way to look at it. And the regional data shows that margin squeeze is happening across the board. It's just driven by different localized pressures. I mean, consolidated adjusted EBITDA fell 9% FX neutral. Take Mexico, for example.
Okay, what's happening there?
Well, revenue there is actually up 4% because of this booming oncology demand, but EBITDA tanked 16%.
Meaning they're paying a massive premium to service that demand, right?
Yeah.
Like absorbing higher pharmacy costs and heavily investing to acquire top medical talent.
Precisely. And then in Colombia, it's a different mechanism, but you get the exact same result. Revenue jumped 13% as they expanded those risk-sharing contracts.
Right. Those are the arrangements where Auna takes on the financial risk for patient outcomes across a wider population.
Exactly. And it definitely drives volume, but statutory wage hikes just erased those top-line gains entirely. It dropped their EBITDA by 12%.
Wow. So are these just growing pains in their expansion markets, or is their mature base struggling with margins too? Because looking at Peru, I mean, revenue grew 8%, but margins just completely flatlined.
Yeah, Peru presents a really unique operational risk this quarter. Auna absorbed some abnormally high billing penalties there. Basically, financially pressured payers, the insurance companies, are tightening their settlement terms and aggressively enforcing billing deadlines.
Right, but management is sort of waiting that off as a legacy reconciliation issue, right? Like, they claim it will be fixed by the end of 2026.
Yeah, they do.
But if insurance companies are fundamentally tightening their belts, isn't that a systemic risk rather than a simple billing glitch? I mean, that feels like a structural headwind, not just a typo on an invoice.
It is absolutely a red flag to monitor. Like, if payer behavior is permanently changing in Peru, those penalties won't just magically vanish because management updated their internal financial controls.
Okay, so margins are bleeding in Mexico and Colombia, and Peru has payer issues dragging down revenue conversion.
Yeah.
So how do we explain that intraday stock recovery? Like, why buy that dip?
Well, it comes down to cash. First half free cash flow surged 181%.
Wait, stop right there. If operating costs are eating their profits and EBITDA is down 9%, how does cash flow nearly triple? Because that math doesn't intuitively track at all.
I know, it sounds crazy, but it comes down to working capital mechanics. So even though operating margins contracted, they optimized their cash conversion cycle.
Meaning they're collecting cash much faster on the revenue they did fake.
Exactly.
Okay.
Outside of those specific Peruvian penalties anyway. And more importantly, that cash is actively deleveraging the balance sheet. Net leverage actually dropped to 3.6 times.
Which moves them closer to that sub-3x target management has been promising for a while now.
Right. And that is the exact signal the market was looking for today. It basically proves to investors that despite the margin noise and the EPS miss, the underlying cash engine is resilient enough to handle their debt load.
That makes sense. So as you map out your thesis on Auna, you really need to keep a close eye on their aggressive physical footprint expansion. I mean, they're pouring capital into the upcoming Lima Sur facility and rolling out all these new robotic surgery systems.
Yeah, those are highly capital-intensive projects. They will need substantial pricing power to justify that kind of spend.
Exactly. The ultimate question is whether these expansions secure a healthcare monopoly for them across Latin America, or if it just accelerates a debt trap if their contractual price increases fail to outpace regional inflation. Anyway, thanks for listening, and make sure you follow the show for your daily earnings coverage.